Global markets are reeling over President Donald Trump's haphazard approach to tariffs and an escalating trade war with China. Stocks have been volatile, and an unsettling shift has emerged in the bond market. Earlier this week, as stock markets around the world declined, U.S. Treasuries also sold off. Stocks and bonds declining in tandem raised red flags. Typically, when investors sell off stocks in times of crisis, they pile into U.S. Treasuries, seeking the safety of an asset backed by the full faith and credit of the U.S. government. Yet as stocks declined, investors abruptly sold off U.S. Treasuries, raising questions about how much they value the promises made by the U.S. government to pay its debts amid concerns about how tariffs will impact economic growth. The sell-off in bonds was so unsettling that it spooked the White House. People were getting a little queasy, Trump said Wednesday, as he told reporters he was watching the bond market. The bond market is very tricky, he said. While previous outcry from Wall Street economists and lawmakers had yet to make Trump step down on tariffs, it was the turmoil in the bond market that made him blink and delay many of his tariffs. The blink came sooner than we expected, probably forced by the markets, said Mohit Kumar, chief economist and strategist for Europe at Jefferies in a note Thursday. The reversal is in sharp contrast to the fanfare with which Trump unveiled his tariff policy just a week ago. The yield on the benchmark 10-year U.S. Treasury note spiked as high as 4.5% on Wednesday. It was a whiplash reversal after falling below 4% and hitting its lowest level since October, just days before. Yields and bond prices trade in opposite directions. U.S. Treasuries are considered one of the safest corners of the market. It's where investors park their cash during economic turmoil and bouts of uncertainty. When stocks and bonds decline together, investors get spooked about broader economic stability. The trend is so unusual, it's associated with moments of extraordinary uncertainty, like the pandemic and the 2008 financial crisis. Wall Street veterans were blunt about how the bond market forced Trump's hand. The bond market spooked the president, Ed Yardeni, president of Yardeni Research, told CNN's Matt Egan. Bond vigilantes were screaming that they weren't happy with what was going on, and there was a potential for a recession. Trump's shift on his reciprocal tariffs serves as a stark reminder of the power and influence of the bond market, which can receive less attention than the stock market. While Trump watched stocks decline, it was a sell-off in treasuries that forced him to move. The bond vigilantes have struck again, Yardeni said in a note. Bond vigilantes refer to investors who threaten to sell or refuse to buy government bonds, often to express dissatisfaction with government policy. Less demand for bonds means lower prices, which means higher yields, and a higher borrowing cost for the government. It's an example of how bond markets can signal to a government it must shift policy or face higher borrowing costs. For a recent example, just look at former UK Prime Minister Liz Truss. Democratic political strategist James Carville famously said in the 1990s, "I used to think that if there was reincarnation, I wanted to come back as the president or the pope or as a .400 baseball hitter. But now, I would like to come back as the bond market. You can intimidate everybody." National Economic Council Director Kevin Hassett said bond markets played a role in Trump's tariff pause Wednesday, but did not cause a panic move. And I think the fact that the bond market was telling us, hey, it's probably time to move, certainly would have contributed at least a little bit to that thinking, but it wasn't the bond market that made a panic move, Hassett told CNBC. In a Fox Business interview Wednesday, Treasury Secretary Scott Bessent dismissed the moves in the bond market as uncomfortable but normal. UBS said Tuesday that investors were selling bonds to raise cash to cover losses on the stock market. Deutsche Bank said Wednesday that U.S. government bonds may be losing their traditional haven status. Whatever the case, the spike in yields alarmed market watchers. The yield on the benchmark 10-year Treasury note is one of the key rates in the economy. The 10-year yield strongly influences mortgage rates and underpins a range of other borrowing costs for everyday Americans, small businesses, startups, large corporations and more. Bessent has been outspoken about his focus on the 10-year yield and his desire to see the yield come down. But a higher rate sparked by Trump's tariffs could be considered a self-own for the administration, and could strain Americans trying to buy a home or take out a loan. The bond market right now is beautiful, Trump declared Wednesday, after his tariff pause. But the bond vigilantes can strike again. The 10-year yield settled above 4.4% Thursday, better than when yields rose above 4.5% early Wednesday, but still far above its dip below 4% last Friday, before yields spiked. It's a sign that relief can be fleeting. And after a historic rally on Wednesday, U.S. stocks were lower again on Thursday. Arun Sai, senior multi-asset strategist at Pictet Asset Management, said that investors see America as a less reliable place to put their money due to the damage the Trump administration is doing to the U.S. economy. The whole Trump-Bessent-Lutnick grand plan is crumbling under the weight of its own inconsistency, Sai told CNN's Anna Kubin. Howard Lutnick is the U.S. Secretary of Commerce. They've done significant damage to the notion that U.S. assets are a safe haven for global capital, Sai said. Chip Huey, managing director for fixed income at Truist Advisory Services, said hedge funds are also unwinding bets tied to treasuries, which could be contributing to higher yields. Demand at an auction for 10-year treasuries on Wednesday was strong, according to Huey, and he thinks yields could fall more as hedge funds tie up their trades. Trump's tariffs have also raised concerns that international investors might sell their treasuries as a negotiating tactic. And Huey said that if there is less being imported into the U.S. from its global trading partners, that could disrupt demand for U.S. treasuries. Less trade with the U.S. means foreign investors have fewer dollars to buy U.S. treasuries. The U.S. dollar index, which measures the dollar's strength against 6 major foreign currencies, tumbled 1.8% on Thursday, a possible warning sign about waning investor confidence in the United States. Our stock market is down, bond yields are up and the dollar is declining. These are not the markers of successful policy, Trump ally and investor Bill Ackman said in a post on X on Wednesday before Trump reversed his tariff policy. Bonds are signaling that the pause is significant, yet not much has fundamentally changed, said ING analysts in a note to investors Thursday. Markets will not easily forget these episodes with wide market swings. Imagine you're buying a house. You need a mortgage. It's a big decision, and the interest rate you get can make a huge difference in how much you pay over time. But have you ever wondered what determines that rate? It's not just your credit score or the bank's policies. There's a bigger player at work here. Now, the interest rate on that mortgage, well, that's influenced by the bond market. The bond market sets the tone for borrowing costs across the economy. When bond yields rise, mortgage rates often follow, and when they fall, borrowing becomes cheaper. It's a ripple effect that starts with bonds and spreads to everyday life. Or maybe you're starting a business and need a loan. Whether it's to open a cafe, launch a tech startup, or expand your existing company, the cost of borrowing money will impact your plans. And yes, the bond market plays a role here too. It helps determine how much banks charge for loans, shaping the opportunities available to entrepreneurs. Guess what? The bond market isn't just for Wall Street traders or financial analysts. It's a key part of the global economy, influencing decisions made by governments, corporations, and even small businesses. It's like the hidden engine that keeps everything running. You see, the bond market isn't just some abstract financial concept. It's a real, tangible force that affects us all. From the interest rates on your credit card to the returns on your retirement savings, bonds are everywhere. It directly impacts our daily lives. Think about the cost of groceries, the price of gas, or even the rent you pay. All of these are influenced, in part, by the bond market. It's a chain reaction that starts with investors and ends with the choices we make every day. We often hear about the stock market, but did you know the bond market is even bigger? In fact, it's the largest financial market in the world. While stocks get all the headlines, bonds quietly shape the financial landscape behind the scenes. It's where governments and companies borrow money. When a government needs to build roads, fund schools, or support healthcare, it often turns to the bond market. Similarly, corporations issue bonds to finance new projects, expand operations, or even innovate. And just like any market, it's driven by supply and demand. When there's high demand for bonds, their prices go up and yields go down. Conversely, when demand drops, yields rise. This delicate balance affects everything from government budgets to individual investments. When investors are confident, they buy bonds, which lowers borrowing costs. This confidence can fuel economic growth, making it easier for businesses to expand and for individuals to afford big purchases. But when they get nervous, well, watch out. A sudden shift in the bond market can send shockwaves through the economy, affecting everything from interest rates to stock prices. It's a reminder of just how interconnected our financial world really is. Think of bonds like loans. You lend money to a government or company and in return, they promise to pay you back with interest. U.S. Treasury bonds, which are backed by the government, are considered among the safest investments out there. They're like a financial bedrock. During uncertain times, investors often flock to bonds. They're seen as a haven, a way to protect your money when other investments feel shaky. This demand pushes bond prices up and yields down. And by the way, yield is basically the return you get on your bond investment. In 2025, something unusual happened. The bond market threw a curveball. Instead of rallying as a safe haven, bond prices tumbled. This meant yields shot up, signaling trouble on the horizon. This wasn't just some ordinary market fluctuation. No, this was the bond market waving a giant red flag. Investors were worried. Worried about escalating trade tensions. Worried about the potential impact on the economy. And let me tell you, they weren't staying quiet about it. The bond market's message wasn't lost on then-President Trump. At the time, he had been engaged in a tit-for-tat trade war with China, slapping tariffs on billions of dollars worth of goods. But the bond market's reaction? It gave him pause. Could the bond market's volatility have influenced Trump's decision to delay certain tariffs? While he publicly downplayed the bond market's influence, some experts believe it played a role. The bond market, it seemed, had the power to sway even the most powerful man in the world. Section 5 Bond Vigilantes, the enforcers of fiscal discipline. Enter the bond vigilantes. Now these aren't your typical vigilantes patrolling the streets with masks and capes. No, they're a different kind altogether. They're investors who use the bond market to voice their displeasure with government policies. So how do they do it? Well, by selling bonds, of course. This in turn pushes bond prices down and yields up, which increases the government's borrowing costs. It's kind of their way of saying, hey, we don't like what you're doing, change course or face the consequences. Section 6. The 10-year Treasury, a canary in the coal mine. For decades, this financial instrument has been a silent sentinel, quietly signaling the health of the economy. Its movements, though subtle at times, can reveal the underlying fears and hopes of investors worldwide. The yield on the 10-year Treasury note is, well, one of the most closely watched economic indicators out there. It's not just a number on a chart, it's a reflection of market sentiment, a barometer of confidence, or the lack thereof, in the economy's future. It influences so much: mortgage rates, business loans, and even car loans. When the yield rises, borrowing becomes more expensive, rippling through the economy and touching nearly every aspect of financial life. When this yield rises sharply, it's often a sign that investors are, worried about the future. It's like a collective gasp from the financial world, signaling uncertainty or fear about what lies ahead. In early 2025, the 10-year Treasury yield spiked dramatically. This wasn't just a blip on the radar, it was a seismic shift, a wake-up call for markets and policymakers alike. And this wasn't just some abstract market movement, it had real-world consequences. Mortgage rates jumped, making it harder for families to afford homes. For many, the dream of homeownership suddenly felt out of reach. The housing market, already under pressure, felt the strain as potential buyers hesitated, unsure if they could manage the rising costs. Sellers, too, faced challenges, as fewer buyers meant longer waits and lower offers. Businesses faced higher borrowing costs, which made expansion plans more expensive and riskier. For small businesses, in particular, this was a tough pill to swallow, as they often rely on loans to grow and sustain operations. Higher costs could stifle investment and job creation, leading to a slowdown in economic activity. Factories might scale back production, companies might delay hiring, and the ripple effects could be felt across communities. The bond market's message? It was loud and clear: the economy was at risk. This spike in yields wasn't just a warning, it was a call to action, a reminder that the financial system is deeply interconnected and that shifts in one area can have profound consequences elsewhere. Section 7 Expert Opinions, Deciphering the Bond Market's Message. The bond market, often referred to as the smart money, has long been considered a critical indicator of economic health. Its movements are closely watched by investors, economists, and policymakers alike, as it often provides early warnings about potential economic shifts. But what exactly was the bond market trying to tell us during this turbulent period? Let's dive deeper into the perspectives of experts and the signals they interpreted. Market analysts and economists, well, they kept a close eye on the bond market, trying to figure out what it was signaling. The yield curve, a key metric in the bond market, had inverted, a phenomenon that has historically been a reliable predictor of recessions. This inversion sent shockwaves through the financial world, sparking debates about the future of the global economy. Analysts were quick to dissect the data, looking for clues about what might come next. Some, like Ed Yardeni of Yardeni Research, believed that the bond market had actually spooked Trump into delaying tariffs. Yardeni argued that the market's reaction to the trade war rhetoric was a clear signal of economic anxiety. He suggested that the administration's decision to backtrack on certain policies was a direct response to these market signals, highlighting the bond market's influence on political decision-making. Others pointed to the role of hedge funds and other large investors in shaping the market's movements. These institutional players, with their vast resources and sophisticated strategies, often amplify market trends. Their actions can create ripple effects, influencing not just bond prices, but also broader economic sentiment. The interplay between these investors and the bond market added another layer of complexity to the unfolding narrative. Mohit Kumar of Jefferies highlighted the sharp contrast between Trump's initial tariff announcements and his later decision to delay them. Kumar noted that the bond market's reaction to these announcements was swift and decisive, reflecting deep concerns about the potential economic fallout. He emphasized that this contrast underscored the market's sensitivity to policy changes and its role as a real-time barometer of economic sentiment. Arun Sai of Pictet Asset Management suggested that investors were losing confidence in the U.S. as, a reliable investment destination. Sai pointed to the growing uncertainty surrounding trade policies and their impact on global markets. He argued that this loss of confidence was evident in the bond market's movements, which reflected a broader shift in investor sentiment. The U.S., once seen as a safe haven, was now facing skepticism from global investors. The bond market, it seemed, had turned into a barometer of global sentiment towards the U.S. economy. Its signals were not just about interest rates or inflation, but also about trust, confidence, and the broader economic outlook. As experts continued to analyze its movements, one thing became clear. The bond market was more than just a financial tool. It was a reflection of the world's economic pulse. Section 8. The bond market's ripple effect, from mortgages to Main Street. The bond market's ups and downs weren't just a Wall Street concern, they sent ripples throughout the entire economy. Rising bond yields, for instance, meant higher borrowing costs for both consumers and businesses. The housing market, which is super sensitive to interest rate changes, really felt the pressure. Mortgage applications dropped as those higher rates priced some buyers out of the market, and businesses? Well, they faced higher costs of capital, which led many to put their investment plans on hold. The bond market's message wasn't just being heard on Wall Street, it was being felt on Main Street too. Section 9. The importance of understanding bond markets. The bond market isn't just for financial wizards or Wall Street insiders, it's actually a fundamental part of our entire economic system, influencing everything from mortgage rates to business investment. Understanding how the bond market works is, honestly, essential for anyone who wants to make sense of the economy. By paying attention to the bond market signals, we can gain some really valuable insights into investor sentiment, government policies, and even the overall health of the economy. Now, the bond market may not always be right, but it's a powerful force, one that absolutely deserves our attention.